Oscar Wilde once described a cynic as someone who knows the price of everything, but the true value of nothing. Relying entirely on the bigger fool theory, buying an asset just hoping someone else will pay more later, is a dangerous game. To find actual value, we usually look at comparisons. Think about real estate. When you buy a house, you rarely calculate the lifetime cash flows of the property. You look at the house next door. But to make an accurate comparison, you first have to standardize the price into a common metric, like price per square foot. In the stock market, investors standardize prices to compare companies using the price-to-earnings, or PE ratio. To accurately price a stock relative to the market, you must execute 4 strict steps: standardize the multiple, know the distribution, analyze the fundamentals, and control for differences. Skipping any one of these steps separates rigorous valuation from a pure gamble and leaves you vulnerable to surface-level discounts. Let's start with step 1, standardizing. Take a close look at this table displaying a target firm alongside 5 competitors. Looking only at raw share prices offers no baseline. We must standardize these into PE multiples. The absolute rule is uniformity. Using trailing 12-month earnings for the target requires using trailing earnings for all comparables. Mixing forward and trailing earnings invalidates the entire comparison. Once your multiples are uniform, you move to step 2, knowing the distribution. Many investors make the mistake of trying to find the typical multiple of an industry by blindly calculating the average. To see why that fails, consider this number line plotting a set of comparable PE ratios: 10, 12, 14, 15, and one extreme outlier way out at 120. Should you benchmark the target against the average of 34.2 or the median of 14? You should use the median. Because multiples have an infinite ceiling, the distribution is heavily skewed positive. That massive right tail pulls the average far away from where typical firms sit. Relying on a simple average in a positively skewed dataset mathematically guarantees that you will overestimate the value of an asset. This brings us to step 3, analyzing fundamentals. You have to ask why one firm deserves a 15 PE while another gets a 20. The answer comes back to the core drivers of any valuation: risk, expected growth, and cash flow generating potential. Every multiple has a companion variable, one dominant driver. For the PE ratio, that companion variable is expected growth. As expected growth increases, the multiple a firm deserves rises right along with it. Knowing this leads directly to step 4, controlling for differences. Many analysts fall into the same industry fallacy, assuming that any 2 companies in the same sector are comparable. But a true comparable firm is defined by similar risk and growth profiles, not just an identical sector label. Imagine our target firm operates in the same industry as its peers, but it has twice the expected growth rate of the median. A direct comparison no longer works. To correct this, you can subjectively adjust the multiple or use a scatterplot regression across the market, graphing growth against PE, to find a mathematically precise predicted multiple for the target. A multiple is never a static number. It acts as a dynamic proxy for the underlying financial engine of the business. Let's bring all of this together. Suppose our target firm currently trades at a PE of 12, while the industry median PE sits at 14. At first glance, it looks like a bargain. But when we apply step 4 and look under the hood, we find the target has significantly higher risk and lower expected growth than its median peers. Because of these weak fundamentals, our regression and adjustments dictate that the target's true predicted multiple should actually be 10. Even though the target appears cheap by trading at 12 compared to the median of 14, its fundamentals demand it trade at 10. It is actually overvalued. Standardize your multiples uniformly. Use the median over the average to avoid outliers. Find the companion variable driving the multiple. And finally, control for fundamental differences in risk and growth. Rigorous relative valuation proves mathematically whether an asset deserves its discount, ensuring you aren't misled by a low price tag.